What's up, guys? Thanks for tuning into Token Metrics TV. This is Jad, the quantitative analyst at Token Metrics, and this is the Quant Insights. All right, so for today, we're gonna go through some analysis on bull markets and bear markets, specifically just looking at Bitcoin. I'm just gonna look at a bullish trend and try to see what kind of analysis I can see in that trend, and then we'll look at some bearish trends and analyze what happens to be able to determine, okay, uh, how should I change my strategy from a bullish trendy market to a bearish trending market? Because it's very important to be able to switch between strategies. Some strategies work extremely well in a bullish or very trendy market, and then don't work well in another market environment, like in a consolidation or wide range. All right, so let's go ahead and discuss. So we're going to look at Bitcoin since 2018 till now. I divided these bull and bear phases as follow. Now, doesn't have to be extremely accurate. I'm just looking at visually what looks like a bearish phase and a bullish phase, and then I'm going to do some analysis on it to see what type of insights we can get from these types of market environments. So initially here, we have the big crash in 2018, and I'm going to consider this as my first bearish phase, and then a very short, strong uptrend in 2019. And then here you can consider it a wide range, or you can consider it a bearish market, but we'll see in the analysis, because here you can see the price is still making lower highs and lower lows, so you can probably consider it as a bearish market, although at the end you kind of broke up above previous highs. And then you have the big bull run of 2020 and 2021, which is here all the way to the top around April, May of 2021. And then here, the most recent prices, I considered it to be a wide range from around 65K to 30K. I'm considering this market environment to be in a very wide range. All right, so the main reason why I wanted to do this type of analysis is to really show my personal opinion on how to trade bullish and bearish markets. Me personally, I like trend following strategies, and I find it very difficult to time the market. So, what I mean is, when I see that we are in a bearish trend, I find it extremely hard, personally. Maybe it's not the case for you or everyone. I find it extremely hard to buy a dip when the trend is downward. And exactly the same in a bullish trend. I find it hard to sell the top during bearish trends, because it requires a lot of market timing. And I personally don't believe that I can time the market in an accurate way. So I want to develop a system that doesn't rely heavily on timing. And since we're not depending heavily on timing, we're going to offset some returns. What I mean is, I'm not going to enter at the perfect bottom, and I'm not going to exit at the perfect top. I find this almost impossible. So we're going to buy at prices that are a little bit more expensive and sell at prices that are a little bit less than the top. So basically, my idea is, whenever we are in a bullish trend, we should trade in a bullish manner. So essentially, in a bullish trend, I'm not going to be looking to sell local tops. I'm going to be looking to buy and accumulate local bottoms. So basically, in a bullish trend, I'm going to be looking for buy the dip opportunities. In a bearish trend, I won't necessarily be looking for buy the dip. I'll be more looking into sell the rip or sell a local top. And so for a bullish trend, to buy the dip, you have you can either buy a spot and control your bet size, or you can another way, which probably is more complicated for crypto traders, is to buy call options once you see a pretty far deviation. And why I believe to buy the dip in a bullish market and not in a bearish market, because simply in an uptrend, prices are more likely in terms of probabilities to rise or keep rising than they are likely to fall. And the upswings in a bullish market are much bigger and tend to last longer than downswings. And similarly for bearish markets, I'm going to be looking to trade in a bearish manner. I'm going to be looking to sell the rip. Either I sell short, or I can buy put options when I see a deviation. Why? Because in a downtrend, prices are more likely to fall than rise, and these downswings tend to be longer and larger upswings. I'm not inventing anything. This should be very intuitive, but let's look at some analysis. All right, so let's first consider the first bearish market, bearish environment that I'm going to consider in my data was from December 2017 to December 2018. So it's represented here. It's almost a whole year of a downward trend. And as you can see, to identify bearish regimes, obviously negative cumulative returns, and then making lower lows, lower highs consecutively is a good way to just visually see if we are in a bearish trend or not. All right, so here in this chart, no need to really look at the chart, but more specifically the H number here. H is the Hertz exponent. It's a very nice metric. It essentially tries to quantify how random or how trendy returns are. So usually a Hertz exponent of 0.5, it means that the time series or the returns follow a random walk. So it's completely random. If tomorrow's price is going to go up and down, it's almost 50-50. But when the Hertz exponent is higher than 0.5, it usually says that there's high autocorrelation, so it's a trend. We have a trending environment. As you can see here, it makes sense during this bearish trend. Hertz exponent was pretty high, so it means that returns are autocorrelated together. So if yesterday was a down move, then it's more likely that tomorrow will also be a down, and so on. So this is not very important, but essentially what I did on my notebook is I'm saying, okay, if yesterday is negative, and if yesterday is negative and I have high autocorrelation, so I want to sell because I believe that today or tomorrow is going to follow what happens yesterday because returns are highly autocorrelated. So just by looking at this, I'm saying, okay, in this bearish environment, if yesterday's return was negative, I want to go short today. And if yesterday's return was positive, I want to go long. But forget the longs. Here we're only talking about the shorts. So in a bearish market, if yesterday was negative, I want to short today. And what is the probability that I will make a positive return for my short? It's a 56% accuracy. 56% probability, excuse me. So essentially, if in this bearish environment, if I just follow a very simple strategy, if yesterday's return is negative, let's short today. The probability of me making money on that specific trade in this specific environment would have been 56%. So that's also showing that returns are autocorrelated, and then there's a clear trend. And similarly for the other bearish market from July 2019 to March 2020, also here, like I said, you could have considered it a wide range. So autocorrelation wasn't extremely high, almost random, but still following yesterday and today, it would have still made good accuracy. All right. So let's look at the entire history that we just discussed. For Bitcoin, we have some bearish environments and some bullish environments. And in this chart, TradingView is already integrated on tokenmetrics.com. So you can access these type of charts and indicators on tokenmetrics.com directly. So here I'm using a bands indicator called Keltner channels, very similar to Bollinger Bands, Easy Bands, and all these types of bands that are trying to tell you you should buy the dip and sell the top and things like that. Now, like I mentioned, I think it relies a lot on timing the market and visually, especially with hindsight bias. Everything I'm doing now, all the analysis I'm doing now, is heavily biased because I already know when the bearish trend started and when it ended. And similarly for bullish, I know exactly when it started and when it ended. So I can really easily come here and tell you, you know what, if it hits the upper band, it's a good time to sell. If it hits the lower band, it's a good time to buy, and so on and so on. This is very biased. And in order to actually test it, you really need to backtest these type of strategies because you need to see quantitatively how this strategy would have worked on the long run. Because here, similarly for the bearish phase, I could tell you, okay, every time you hit the mid band, it's a good time to buy, start accumulate here, here as well, and then suddenly, boom, doesn't work anymore, and here you can have a very big loss. Now, the Keltner channels I'm using here, it's very simple. The mid band is essentially the exponential moving average. I'm using a 30-day exponential moving average. And the bands are just a multiple of ATR. ATR is average to range, so it's a measure of volatility. And this type of indicator is actually very helpful. It can help you decide where to put your stop losses when you enter a trade. Usually, when you enter a trade, you can put your stop loss below, if you're long, you can put your stop loss below or at the lower band, which is the 2 ATR. And if you want to set your stop loss on a short perspective, you can set it on the upper band, which is 2 ATR on the upside. All right, so let's discuss the bearish phase and how we can use something like Keltner KC channels to trade. Okay, so here is what the Keltner channels look like. Like I said, it's just ATR values, and the midline is the exponential moving average. So here, I know already that this whole time is a bearish market. So I have hindsight bias, and I'm not going to come here and tell you, you know what, you could have bought here, sold here, bought here, sold here, bought here, sold here, and so on. Because at that point in time, you didn't really know if you were in a strong bearish trend, when it's going to reverse, and these type of things. That's why it's very important to always backtest these types of analysis and see statistically how they perform. So here is the Keltner channel in a bearish market. And like I told you, in a bearish trend, I want to trade in a bearish manner. I don't want to buy the dips. I don't want to buy the lower bands when the whole trend is going downward, because I can suffer from it. For example, here at this point, if I bought here, it wouldn't have been a very good trade. And most importantly, if I bought here, the system would have broken completely, and I would have lost a lot on this specific trade. So the type of strategy I want to look at is very simple. Since I know from hindsight that I'm in a bearish environment, I'm going to sell the exponential moving average cross. So every time I'm above it and I go below it, like here, for example, I want to get a sell order, and I'm always going to set my stop loss at the, oh, sorry, here's the typo, at the lower channel. So 2 ATRs below my entry point. So this how, so for example, here I would have had a short signal, and then my stop loss would have been activated here. Similarly here, I would have went short all that time, and then my stop loss would have been activated somewhere here. All right, so let's actually see the signals visually. So here, all the red dots are where and when I opened a short position, and the green dots are essentially me hitting a stop loss. So you can ignore the consecutive ones. The first one is when I hit my stop loss the first time. So just by following a very simple strategy, knowing that I am in a bearish environment, I can see that, okay, I can short here, my stop loss would have been activated, but overall, most of my shorts would have been pretty good shorts, because I'm not trying to buy the dip in a bearish environment. I'm trying to sell the rip, basically. All right, now let's discuss something nicer, the bullish market and the bullish phase. So similar analysis that I'm going to do. So I'm looking at March 2020, so post-COVID, all the way up to the market top in April 2021. So here, also I'm looking at the Hertz exponent to evaluate the autocorrelation, and it's very, very high. I think it shouldn't even be above 1, so I would have to double check the data, but it's still fairly autocorrelated. So in an uptrend or in a bullish phase, high autocorrelation and returns. So if yesterday price went up, today is more likely to follow and go up. So similarly, I want to backtest this simple strategy of saying, if today went up, let me buy. And in that case, if I just follow yesterday and do the same today, probability of making profit would be 62%, which is pretty high. All right, so in a bullish phase, now it's very easy for me to come and tell you, hey, when you hit the lower band, it's a very good time to buy here, sell here, buy here, sell here, buy here, and so on and so on. Visually, it seems like it's good because I have hindsight bias, but let's go ahead and test it to statistically determine what's going on. So very simple to the strategy I just described earlier for the bearish phase. I'm going to use the KC channels. And since I know that I am in a bullish environment, I'm going to buy every time there's a EMA cross, and I'm going to set my stop loss level at the lower channel. So let's evaluate it visually. So every time I have a cross above the green line, I have a buy signal with the undetermined bet size for this type of analysis. So here I buy, I'm accumulating until the first time I hit my stop loss would have been somewhere here. And then I keep buying every time I test this 21-day, this 30-day exponential moving average. So as you can see visually, it seems good. Now, if we go ahead and plot these signals, like I said, every time there's a cross and exponential moving average, I buy with a small bet size, all the way until at one time I hit my stop loss at this time. And then I was constantly accumulating during the uptrend. All right. So what are some issues with using any type of bands or channels? Like I mentioned, when you look at it visually and you look at these bands and say, okay, like here would have been a very good time to buy, here would have been a good time to buy as well, here, and then suddenly there's a big loss that occurs. So one thing is use stop losses when you're trying to follow channels and these type of things. But also it's very important, like I mentioned, to know when to switch from buy the dip type of environment to sell the rip type of environment. Because buying the dip is not always a good idea. When you are in a downtrend, sometimes it's better to just sell and sell the rip than to be looking for exact timing and buying a dip to later sell the top and make small profits, because timing the market is extremely hard, if not impossible. All right, so let's discuss what kind of issues we can see by following these type of indicators. Now, for these signals, what I'm doing is when I have an exponential moving average cross, I want to buy. And I will set my stop loss at the lower channel, like I discussed earlier. So, like I discussed earlier, in a bullish market, that works pretty well. But let's see when suddenly the market changes and is not bullish anymore. So, if I keep doing the same thing, which is buying the dip and so on, what will happen when the market environment changes? So here is, okay, I have an exponential cross, I buy, and then my stop loss gets hit once here, and then I'm always long until my stop loss gets hit here. I have an exponential moving cross, and then my stop loss gets hit here. So this in a bullish environment is not very bad. It's a fairly good strategy to use. Holding would have probably been better because your stop losses were hit exactly when there was a reversal, until the big trade happens here, where your stop loss gets triggered and then the entire market market regime changes from bullish market to either you can consider a small bearish phase here or a wide range. So the importance of switching between buying the dip, selling the rip is really shown here, because if you just keep doing what you're doing in a bullish environment and you keep doing it in a ranging environment, then it's not going to be very well and very accurate. Like here, you're going to have some bad trades, especially if you start shorting. It would have been bad, but the accuracy of these trades is not very well. So this just to show that really think of what market regime am I in, and then decide, okay, this strategy works well for a bullish phase. I think I'm in a bullish phase, so let me run this strategy, and so on. Because of these things I mentioned. In a bullish trend, prices are more likely to rise and fall. This is obvious because of the trend. And these swings tend to be longer and larger. So me, personally, in a bullish phase, I'd be looking to buy the dips and accumulate through spot buying or buying call options. But in a bearish phase, I personally wouldn't be looking to be buying dips, because it relies heavily on timing the market. I would more likely be selling rips, going short, or buying puts. All right, so thank you for watching. I hope you enjoy this type of content. We'll be always providing more content on what type of strategies work best for bullish, bearish, or in a wide range. So stay with us and see you next time. Thank you. Goodbye.